In this video, we will be going through a work example on shares and debentures financing, the following FRS, as well as the following financial statements. Elisha Limited is in the business of importing and distributing electronic products locally and regionally. So here's the trial balance as at 30 September 2018. And the following pieces of information has not been accounted for. And we are required to prepare these three financial statements. But before we start, let's account for these pieces of information that has not been accounted for yet.
Point 1. To increase the value of the land by $100,000, we know we need to debit land by $100,000. If an asset was previously devalued, a company can recognize a revaluation gain not more than the amount of revaluation loss previously recognized. You may want to look at the diagram here. The increase in value of $100,000 is within the $250,000 loss previously recognized, so we can recognize a revaluation gain and credit revaluation gain by $100,000. Point 2. This is a case involving impairment of assets. To assess impairment of asset, we need to compare the net book value with the recoverable amount. Let's compute the net book value as at 30 September 2018 first. If you refer to point 4, you will realize that delivery vans are depreciated over 10 years. We will take the cost minus accumulated depreciation minus this year's depreciation charge, and we will get a net book value of $37,500 as at 30 September 2018. Next, the fair value is higher than the value in use, so the recoverable amount is the fair value of $29,000. The amount of impairment loss to recognize is $37,500 minus $29,000. $8,500. We will debit impairment loss and credit accumulated impairment by $8,500. Point 3. The interest expense incurred but not yet paid is from 1st July 2018 to 30 September 2018. This is 3 months, July, August, and September. The accrued interest expense for the 3 months would be 5% multiplied by the debenture price of $500,000 multiplied by 3 over 12. Giving us $6,250. We will debit interest on debentures and credit accrued interest by $6,250. Point 4. The depreciation charge on delivery vans for the year is simply $375,000 divided by 10, $37,500. We will debit depreciation expense and credit accumulated depreciation by $37,500. Point 5. The impairment loss on inventories is $587,300 minus $291,600, $295,700. We will debit impairment loss on inventory and credit inventory by $295,700 to reduce the value of those inventories to the net realizable value. Point 6. The dividends paid to the ordinary shareholder is 2 cents multiplied by 1.28 million. Giving us $25,600. We need to pay the preferred shareholder dividends as well. We will take the dividend rate of 4% multiplied by $200,000 and multiply by 3, giving us $24,000. The total dividends paid would therefore be $49,600. We will debit retained profits and credit cash at bank by $49,600. Point 7. We will take the price of $1.50 multiplied by 2 over 5 multiplied by 1.28 million, the number of ordinary shares, giving us $768,000. We will debit cash at bank and credit ordinary shares by $768,000. Point 8. The journal entry to record this transaction is to debit retained profits and credit general reserve by $20,000.
Before we prepare the financial statements, I would like to make adjustment to the trial balance based on the journal entries we prepared earlier on. We also have some new line items, so I will just add them here. For example, we have a revaluation gain where we credited it by $100,000. Let me just make sure that the adjustment sums up to be equal. Yes, they are. So I can compute the adjusted balance here. There I go. So let me just make sure the total debits equal to the total credits. Yes, they are.
Let's prepare the statement of profit or loss. I will put the adjusted trial balance on the left for easy reference. For revenue, we will use the sales figure from the trial balance. The cost of sales figure would be the cost of sales plus the impairment loss on inventory, giving us a gross profit of $255,000. Other sources of income for the company include the interest income and the revaluation gain. For selling and distribution expense, we will use the figure in the trial balance, as well as the depreciation on delivery vans, since the question mentioned that depreciation on delivery vans are charged to selling and distribution expenses. The general and administrative expense would simply be the figure according to the trial balance. When it comes to impairment of assets, we would generally classify it as other expenses. This will give us an operating profit of $974,000. Interest on debentures would be classified as a financing expense, so this will give us a net profit before tax of $956,000. Now, we need to compute the taxation for the year. To do that, we will prepare a tax computation. Since this is financial year ending 30 September 2018, the year of assessment is 2019, which is 1 year after the last day of the financial year. We will start off with the net profit before tax as computed earlier on. Then, we will deduct non-taxable income. Here, we have a revaluation gain, which is not taxable because it is a capital gain. Next, we will add non-deductible expenses. Depreciation is not deductible, so is impairment loss. This gives us an adjusted trading profit of $902,000. Next, let's compute the capital allowance claim for delivery vans. We will look at point 11 to determine the amount of capital allowance claim. For those purchased by 30 September 2014, it can be claimed in year of assessment 2015, 2016, and 2017, 3 years. For assets purchased by 30 September 2015, it will be years of assessment 2016, 2017, and 2018. Do the same for the remaining 2 years. In this question, we are in year of assessment 2019. Therefore, looking at the years where the company can claim capital allowance, we notice that only assets purchased in the financial year ending 30 September 2016 and 30 September 2017 still qualify for capital allowance. So the capital allowance claim for the year is $75,000 plus $150,000 divided by 3. That would be $75,000. We will then arrive at a chargeable income of $827,000. Next, let's compute the tax exemption scheme. The first $10,000 is exempted at 75%. The next $290,000 is exempted at 50%. So this gives us a taxable profit of $674,000. We will multiply the taxable profit by 17%. In year of assessment 2019, the corporate income tax rebate is 20% of tax liability, but capped at $10,000. If you take the tax liability of $114,000 multiplied by 20%, you will get a figure higher than $10,000. So the corporate income tax rebate is $10,000. This gives us a current tax liability of $104,000. Next, the deferred taxes. Shown here are the assets and liabilities line item from the trial balance. Just that I netted off the delivery vans cost against the accumulated depreciation and impairment loss. For cash at bank, the tax base is the book value, since there shouldn't be any difference in the treatment between FRS and tax law on cash. The same goes to accounts payable and accounts receivable. For the land, the tax base is equal to the book value, since land does not qualify for capital allowance, neither is it depreciated under FRS. Next, delivery vans. Its tax base is the tax written down value, which is cost minus total capital allowance claim. Let's revisit point 11 again. For assets purchased by 30 September 2014, capital allowance have been claimed from year of assessment 2015 to 2017, meaning it's fully claimed, and the tax written down value equal to 0. The same goes to assets purchased by 30 September 2015. And for assets purchased by 30 September 2016, assets purchased in the financial year ending 30 September 2017 qualifies for capital allowance from year of assessment 2018 to 2020. So this means the company can still claim 1 more year of capital allowance. The tax written down value of these assets would be 1/3 of its cost. This gives us $50,000. The tax base of inventories is the same as the book value. The same goes to the 5% debentures, deferred tax liability, and accrued interest. So now, we will compute the difference between the book value and tax base. Only the delivery vans have a difference of $202,100. This is a taxable difference. Therefore, the total taxable difference is $202,100. At the start of the year, the deferred tax liability balance is $29,400. The ending deferred tax liability balance for the year is the total taxable difference multiplied by 17%, $34,000. As we can see, the deferred tax liability balance has increased by $4,900. This is the deferred tax expense for the year. Now that we have computed the current tax and deferred tax, we can enter the following journal entry. Coming back here, the taxation figure is $109,600, giving us a net profit after tax of $846,400. Lastly, we will compute the earnings per share. The formula for earnings per share is as follows. For the net profit after tax, we will simply use the figure we have computed earlier on. The preference share dividends is the dividend rate multiplied by the number of cumulative preference share. 4% multiplied by $200,000, $8,000. Next, the average number of shares, computed using the following formula. It may be helpful to draw a timeline like this. On 5th August 2018, the company's rights issue were paid up, increasing the number of shares by 512,000, obtained by taking 1.28 million multiplied by 2/5. 5th August 2018 to 30 September 2018 is 57 days, so the time waiting factor is 57/365. Therefore, the average number of ordinary shares is 1.28 million plus 512,000 multiplied by the time weighing factor of 57/365, giving us over 1.3 million shares. That gives us 61.65 cents. Moving on to the balance sheet, we will start with the current assets. The bank balance is simply the cash at bank balance. We will use the accounts receivable balance for the trade and other receivables line item. And the inventories line item is simply the inventory balance. This will give us a total current asset of $6 million. Next, the non-current assets. We will aggregate the net book value of all tangible non-current assets into the property, plant and equipment line item. So we will take land plus delivery vans minus the accumulated depreciation and accumulated impairment. The red circle represent a plus and the blue circle represent a minus. This will give us $952,000 and a total asset of $6.9 million. Next, the liabilities plus equity section. For trade and other payables, we will use the accounts payable balance and the accrued interest balance. Please combine all payables and accrued expenses into a single line item. The provision for tax balance will be the figure we computed earlier on for the current tax liability. This gives us a total current liability of $1 million plus. Moving on to non-current liabilities, we will use the 5% debenture for the borrowings line item. The deferred tax liability will be the ending balance we computed earlier on for the deferred tax component. This gives us a total non-current liability of $534,000 and $1.7 million of liabilities in total. Now to the equity section. We will aggregate both the ordinary shares and cumulative preference shares into a single line item, share capital. The company has only one reserve account, the general reserve. And for retained earnings, we will use the figure from the trial balance plus the net profit after tax for the current year, giving us $2.9 million. This gives us a total equity of $5 million and a total liability plus equity of $6.9 million, which is the same as the total assets. Lastly, let's prepare the statement of changes in equity. We start off with the beginning balance, and we can refer to the unadjusted trial balance for the beginning share capital balance and beginning retained profit balance. The company did not have any reserves at the start of the year. The company paid dividends amounting to $49,600 for the year. This dividend is paid out of profits, so it will decrease the retained profits. It also held a rights issue, which would increase the share capital. When the directors transferred funds to the general reserves, it decreases retained profits to create a reserve account. I want to draw your attention to the total equity column. A transfer of funds to general reserve does not cause equity on the overall to change, so the total equity column should show a zero change. Lastly, we will recognize the profit for the current year into the retained profits. And here, we arrive at the ending balance, which is the same as the balance sheet figures.